Good morning. I'd like to welcome everybody to the June 2025 HdL California Sales Tax and Economic Drivers webinar. I'm very glad that you've been able to join us. We're going to have some more people coming on here, I think, in the first few minutes. Just a couple of housekeeping things as we get started. I want to let everyone know the presentation is being recorded, and that, along with this slide deck, will be available on our website very soon after the webinar. Everyone that's registered will get a confirmation email to let you know that that's posted. And then also, over the course of the webinar, we would love getting questions. And if you could open the chat window, just clicking on that conversation icon at the top of your screen, and feel free to ask a question. My colleagues and I will do the best we can to address those as we go over the course of the hour. And if we don't get to them right away, we will make sure we do that at the end of our time together, where we have some Q&A set aside. I am Ken Nordoff by way of introduction, and I'm pleased today to be joined by my colleagues, Ken Brown and Tracy Vesley. We're part of the client services team that serves a broad number of California clients, and we're the folks that do the analytics and the meetings and the forecasting, and we're happy to be sharing our expertise with you this morning. Of course, I think you're all aware of HdL. We've been around now over 4 decades. We continue to grow our client responsibilities. We're up over 900 cities, counties, and special districts that we serve in the sales tax space. Generating a lot of recovered revenue, and also very pleased to be able to have a high retention rate built on our years of experience and expertise. So today we're going to begin talking about some statewide results regarding the first quarter of 2025. That would be the January to March sales of this year. And we're always comparing that, of course, to the same quarter of the prior year. So what I wanted to highlight here for you was we saw an overall 0.3% gain in this particular quarter, and that was good news and very much in line with what we had expected would occur. You can see at the bottom here we had essentially a flat revenue compared to 1Q24. On the right, you're going to notice how that result of 0.3% breaks down by region. And it looks different, particularly in the more inland parts of the state, but I think some context there that might be helpful in understanding that is Southern California, which is all the counties in the Southern California part of the state, accounts for more than 50% of the statewide sales tax. It's actually 55% this quarter. And so that number there was fairly neutral, and you can see some movement up or down in other parts of California. So what's happening from a trends perspective? This chart on the right is trying to illustrate for you roughly ranges and increments of $2 billion and plus. And what we've seen in this quarter, and comparing it back to the first quarters of the prior 3 years, it's just a gradual decline a little bit in sales tax. The dollar value in 1Q25 here is essentially $2.15 billion, kind of right in the middle of that range. And it's down slightly, but largely unchanged from where it was back in the first quarter of 2022. And for me, what that translates to is the inflationary effects of higher pricing on taxable goods has actually led to a fewer volume or lower volume of transactions over the last 3 years. There are a whole number of economic indicators as we consider what our forecast is going to look like. These are some of the key drivers, and we'll hit on some of these as we go through the presentation today. Certainly, inflation is a big part of that. It's been around for a while. It's being closely monitored. It has an overall effect on consumer spending, and lately is getting compounded with a lot of discussion around tariffs. You can see that interest rates, and I'll show you some slides here in a moment, are having an effect in overall credit access and even some equity in terms of access to money. And we've seen a lot of volatility recently in fuel prices, even as recently as this last week. Ken's going to go into that in a little more detail. And so while that may be painful to see prices rising from the consumer perspective, it is a helpful outcome in terms of generating sales tax revenues. So I'm going to drive through a little bit more detail in some of these areas. Let me start with interest rates. So the Fed committee, when they met this month, left the target Fed funds rate unchanged, a range of 4.25% to 4.5%. It hasn't changed since it was last done, started to retreat a little bit back in December of 2024. They are spending their time, obviously, analyzing a lot of data with an ever-evolving economic outlook. They're mindful of what the employment levels have been, or unemployment levels, which remain fairly low, both nationally and in California. Very sensitive to the labor market conditions and keeping an eye on inflation, a lot of core inflation indices. So they're exercising patience is the way they would summarize that. And I think the best case scenario, looking ahead for the balance of the year, is that there may be 2 minor rate reductions, not necessarily having a great influence on overall consumer behavior. Personal savings rates. And so this is just taking a look at the trend that's been going on for the last decade. You can see recently they come in at 4.3%. This is a matter of just measuring, this is the Bureau of Economic Analysis, measuring household savings against disposable personal income. And of course, when we went through the COVID crisis together, there was a lot of retreating on spending and a lot of piling up on savings that has sunset. And we've seen over the last couple of years that the savings rate has settled in below 5% on a national average. Pardon me, I skipped a slide. I think this is really important. This is coming from the Bank of America, talking about consumer feelings versus actions or sentiment. And so what the line graph here is trying to illustrate sentiment. You can think of that as emotionally kind of how consumers are responding to what's ever going on in the economy or what they might anticipate. You can see that varies quite a bit. And most recently has been, rocked a lot with inflation and the implementation of tariffs and other things. You can see most recently that the sentiment really dropped off here at the very right edge of this graph. What's interesting in the data that Bank of America points out is kind of regardless to some extent of the sentimentality of the economy and where things are headed, consumer spending, which is the red line measured by credit cards, has remained fairly constant. And again, holds up that way even in the most recent data. And so it's just clear that sentiment has fluctuated much more than credit and debit card spending growth, particularly in these last few years. Goods versus services, another indicator that we keep tabs on. This is a graph coming from Wells Fargo Economics. What's interesting is we've obviously seen some overall price growth, but it's kind of been held in check as recently as May. There's some evidence that there's an increasing trend. You can see that in the lower right here on goods, prices coming up. That's experienced a year-over-year gain for the first time in months. And then we've got commentary from them suggesting that it's kind of early to declare victory, that these significant increases in tariffs, which are now in place, less so than they were initially anticipated, they really occurred March through May. And there really hasn't been enough time to determine if the full effects of these policy changes are going to be felt on output, hiring, and pricing. Wells Fargo is still anticipating that a CPI core increase of around 3% is going to occur over the next few quarters. Tariffs. This is a hot topic. I'm sure you're very interested in this. This is a data point coming again from the Bureau of Economic Analysis, comparing a couple of things, trying to look at imported goods. To start with, most of the 20% year-over-year gain was in anticipation that tariffs were coming. very little of that import occurred in April. It was really January through March, and a pretty sizable increase in the first 4 months, trying to mitigate the impacts of tariffs, get goods onshore and in stores before tariffs take effect. The effect of that is mitigating price increases, and there will be some inflation impacts in the short run with that level of behavior. Also note the trade deficit, kind of an inverted data point, but rose substantially in that same 4 month period. Consumer spending, try to gauge, what's happening as we look at services versus goods. Services in this graph are the gray bars, goods are the orange. What's interesting here in April, the most recent data would show that there was an overall almost $48 billion increase. But breaking down these categories, when you look at household spending on increased rent, utilities, healthcare costs, other things that generate tax revenue, that was actually up $55 billion. And the 48 billion net was an $8 billion decline, as you can see here in the spending on goods, things like motor vehicles, clothing, and recreational goods. So I want to just conclude kind of a statewide perspective and just show you what's been happening here in recent quarters and what we have in the coming 5 quarters. So we've had an 8 consecutive quarter decline. You can see that here kind of boxed in the red. And that's been gradual over all of calendar year 22 and 23. We bottomed out in this quarter where we see a very modest increase. And now I'm going to have an opportunity to turn what you see here into these short-term increases in the coming quarters. I'm going to turn some of the content of that over to my colleagues. We're going to drive through the 8 categories that we summarize our sales tax data and our outlook. And we're going to begin with Ken Brown talking about autos and transportation.
Great. Thank you so much, Ken, for that introduction. And yes, our first category that we're going to lead off with today is autos and transportation. It's a pretty tough subject, really, because if you've been following the news, many of the automakers themselves have pulled their profit and sales forecasts altogether, given the uncertainty that we're dealing with posed by the new tariffs. So a good question, if Stellantis and Mercedes can't do it, how can anyone? But we're going to give it a shot here this morning. And so in terms of a brief recap on the major news associated with this group, as we discussed in detail 3 months ago in our last webinar, a 25% tariff on imported autos and also auto parts was imposed in April and May of this year. Now, there are certain exceptions and some partial exemptions to these tariffs for North American produced content. But overall, there's a lot of estimates in terms of what that will do to pricing. But what I believe is reasonable, some of the more reasonable estimates seem to indicate that a price increase will follow of maybe somewhere around $2,000 to $2,700 per vehicle as we move forward. So that equates to about a 6% cost increase. So up here on the screen right now, let me get my marker out, my laser pointer. You can see the new vehicle pricing chart. This goes through April. And you can see that so far there's really not too much impact, but it's early, right? It's early days. The tariffs were just getting imposed, not even fully imposed at this point in time. So we'll have to wait and see where that goes going forward. Over on the right, this is actually right now a little bit more interesting. This is a graph of inventory, and you can see that the graph goes all the way back over on the left side of the screen here to 1995, and we were pretty consistent with our inventory levels for many years. Of course, we had the COVID dip, not a surprise there, but we since had a big increase in inventory coming out of COVID, but not to the level that we were at previously. And in fact, one thing that's a bit concerning to me that we're going to watch is that over the last year, inventory has actually dipped again. And this is going into the tariff environment, this new environment we're in. So that could have some significant pricing pressures going forward. So that's certainly something to watch. And then flipping forward here to the next screen. So we talked about a perhaps 6% increase in auto pricing based on the tariffs. And we all learned in economics classes way back when that when prices go up, demand goes down. And so there's a lot of, just like for the price increases, there's a lot of different estimates out there in terms of how demand will be impacted by these tariffs for autos. But on the screen, you see just one such forecast by BCG, and they expect a decline of about 4% in sales volume in 2025, according to their base estimate. So putting it all together, you've got your 6% price increase, but then you've got a 4% potential decrease in sales volume. That's net 2% in terms of overall tax revenue that your agencies might expect to see overall in terms of looking forward in terms of the future growth projections for this group. And as you can see here, that's pretty much what we've got in terms of our forecast. For fiscal year 25-26, we're looking for about 1.4% sales tax growth from autos and transportation. And this is completely unchanged from last quarter. We pretty much came very close to our estimate this quarter and don't see a reason to change it. It looks like every every data point that we've looked at so far seems to confirm this as a reasonable, but of course, we're going to be watching this very closely. No one really knows with tariffs. This is a new environment that we really haven't seen before. So it's something we're going to be watching closely, along with Stellantis, Mercedes, and others that have pulled their financial guidance. So we're going to be right there along with them. But so far, we feel that forecast is very reasonable. And so far, it's turning out to be pretty darn accurate. Now, turning now to the fuel and service station major industry group, this graph here on your screen shows, it shows the green line here is 2025. So this is year to date compared to the prior year numbers, actuals up above in the light gray line. And so far in the second quarter, we're down about 6% year over year in terms of fuel and service station, what we would expect based on fuel prices. And so obviously that gives us a pretty good idea what's going to happen next quarter when we get the data from the state for April, May, and June. But the next question is, well, where do we go from here? What does the outlook look like going into fiscal year 25, 26, and beyond? So in terms of that, there are a lot of factors that we look at when we're putting our forecast together. And a couple of the biggest ones are oil prices here, demand, and then, of course, legislation, particularly California legislation. So one of the things that is so amazing to me is in terms of oil prices, it is really hard to believe that we just went through this Middle East conflict. There is a ceasefire right now in place, but pretty rocky times over the last month or so. And despite that, if you can believe it, the price of oil is actually 19% lower than what it was a year ago as we sit here in June. So that's pretty incredible and pretty surprising given the geopolitical events. And I think much of the thanks for that is basically the United States, as we've talked about in prior webinars, is now the leading global producer of petroleum, which is surprising because just a few years ago, back, I think it was 2018, we were still an importer of crude. Now we are the world's leading exporter. And the big reason for that is, of course, shale technology. And so I think that has helped to keep the global oil market well supplied and to tamp down some of the volatility related to these global events that we've been living through. But also important is consumption. And so I'll have a slide in just a moment on consumption in California, which certainly has an impact on fuel prices here. But then also important on the price pressure side here in green is California legislation and policies. And we do have a few new policies and various legislative actions that are going to require, for one, a new cleaner blend of gasoline starting this July 1, which is going to be more costly for refiners. But turning real quick to the consumption question, consumption has been trending down in California for fuel. And even here with the data that we have available to us, In early 2025, we're down again about 1.8% so far in the year. And in large part, that's due to the increasing electrification of the California vehicle fleet. Last couple of years, we've seen about 25% of new cars sold in California. They've been electric. And of course, the state wants to long-term make all cars in California, phasing out gasoline cars and make all cars electric. And so the consequences of that, though, unfortunately, combined with, decreasing demand for fuel resulting from that, combined with more expensive regulations, and also some of the plants in California, the refineries are getting older and more expensive to maintain. We're starting to see some closures. And there's been a couple that have been announced. Two plants are for sure, Valero and Phillips. And another one here, the Wilmington refinery has also been talked about in terms of potential closure. And if you combine all those, that's 22% of the state's refining capacity, which could certainly have a pretty significant impact on fuel prices. So that is why we're projecting an increase in tax revenue from fuel sales beginning in 3Q25. And so overall for 25-26, we're projecting about a 5% increase overall in fuel sales coming off of a negative 10% year last year. So I think the important point here is given, we've lived through a lot of geopolitical volatility, but our forecast really, at least in this case, is driven primarily by local issues, California issues such as legislation, fuel demand, and refining capacity, much more so than the worldwide events we've been hearing about more prominently in the news. Turning to the building and construction industry, we've heard about a lot of risks to the economy. We've talked about a few of them this morning already, tariffs, immigration policies. But I would argue that there is a third risk out there, a sneaker risk, maybe even bigger than the other two potentially, and that is the residential housing market. And this is due to challenges posed by affordability. There are many ways to look at housing affordability, but a simple way is by dividing the national household median home price compared to household income. And then what you get is the graph that you see up on your screen right now. Home price affordability as exhibited by price divided by household income. And by this account, residential housing is even more expensive now, if you can believe it, than what it was at the peak of the last housing bubble back in 2005, 2007. So pretty scary, right? But the good news is that most analysts don't think the market is going to fall significantly. It is still in pretty decent shape. We're starting to see a few cracks. We've also seen a couple cracks a couple years ago, though, that turned out to be a false positive. So we'll have to wait and see. We're going to be watching this closely. But I wouldn't be surprised if we experience in the next few years some combination of lower mortgage rates, which we're all looking for, pricing stagnation or modest declines, and certainly some wage growth, inflation, which would work to slowly rebalance the market over time. But this will be certainly a headwind for the sector as we think about what the future holds for the next couple of years. So therefore, in terms of the residential housing market, again, we're closely watching the expected path of interest rates, given it's important in unlocking pent-up demand with hope for lower rates. There sure are a lot of people right now sitting on those sub 4% rates and not wanting to move, given that they've got such a great deal. If we do get lower rates, at some point that would at least unfreeze the market a little bit, make home purchases a little bit more affordable as well. But until that happens, market participants are becoming a little bit more pessimistic. We just saw a recent read on home builder sentiment, for example, that neared a pandemic low. Those that are staying put, however, have been starting to spend a little bit more money on fixing up their homes. We've been hearing from Home Depot and Lowe's and their public forecasting and their public pronouncements that they're projecting very modest same-store sales growth. So to some degree, that will support our forecast for the building and construction sector in the near term. And, you know, another thing that's sort of interesting as we look at the data statewide is we're starting to see some more spending on data centers and artificial intelligence related projects spread out both across the building construction and the business and industrial categories, which is also positive for the outlook and sort of interesting too, particularly when you see it in individual jurisdictions. So putting this all together, we're forecasting very flat growth in fiscal year 25-26. We're looking for growth of only about 0.2%, which comes after 3 years of modest spending declines. So not a lot happening, certainly a group that we're going to be keeping our eye on going forward. And then fourth, I'm going to conclude my portion of the presentation with a discussion of the food and drug industry group. And because most of food items that are purchased in grocery stores for home consumption are exempt from taxation in California, this is a relatively small group in terms of importance related to overall sales tax in California. The group is only about 4.5%, but it is certainly an interesting group in terms of reflecting many converging trends. And a couple that we've been watching, you've heard about it in previous presentations, but to delve into it a little bit more here now, is that we've seen the continued consolidation of drugstore chains with stores closing. And we've also seen continuing drops for several years now in cannabis revenue. So in terms of those two items, pharmacies, one of the big reasons for consolidation of these stores is lower reimbursement rates for drugs. And I think also there are more and more consumers that enjoy the convenience of mail order pharmacy delivery programs, or just like buying their products that they would have maybe purchased in a drugstore when they popped in for their medications before. Maybe now they're buying them on Amazon or other online retailers. So we saw, I think, spending in this category with the store closures drop about 11.5% this quarter. So pretty significant impact in that subcategory within the food and drug sector. Same thing with cannabis. We're still seeing declines. You can see steep declines for the last 3 years. Really, we were down again about 10% this quarter. A lot of reasons for that. One of the reasons is certainly the illegal competition, but there's a lot of other. It's a complex market, a lot of things going on there. So summing it all up for the food and drug sector, we did see some big declines, food and drugs and also cannabis, but those are small, relatively speaking, components of the overall group. And so we are expecting some continued losses there as we work through those two issues. But overall for the food and drug sector, we're looking for a modest decline of just over 0.5% in fiscal year 25-26. So with that, I'm pleased to turn over the presentation to my colleague Tracy that will cover the remaining major industry groups. Tracy, I think you're on mute there.
Of course I am. All right. Thank you, Ken. And hello, everyone. Let's talk shopping. And we're going to dive into general consumer goods as a tax group. It encompasses brick and mortar retail sales. We're going to talk e-commerce as well, which kind of straddles a couple of tax groups. But right now, looking at brick and mortar sales, the slide on the screen right now, you will see that it is highlighting really kind of the top 10 business sectors within this group. You see a lot of red, unfortunately, on this screen. 9 out of 10 business types posting negative results. Discount department stores is the largest segment within general consumer goods. This comprises stores such as Walmart, Costco, Target, etc. It represents 33% of the entire group, and it contracted a little over 2% in the first quarter. I will note that many discount department stores report fuel with their retail sales. And as Ken just walked through, the price of gasoline was down in the first quarter. That could have contributed to the overall decline for discount department store results. The one little speck of green that you see on your screen is related to home furnishings, and kind of unique because in past quarters, home furnishings really one of those sectors that is more discretionary has come in as a, in decline. But here we see a little bit of a bump. Home furnishings are largely durable goods, and this sector possibly could have benefited from some pulled forward demand from perceived price increases from tariffs. And then at the bottom of the screen here, I'll get my laser pointer out now. This is the fun tool we get. The big decline with variety stores, comprising only 2% of the general consumer goods group. But I did want to just note that this is reflecting Chapter 11 filings and the correlating store closures from stores such as 99-cent Only and Big Lots over the past year. All right, let's look at retail sales total picture. This trend graph looks at the whole thing, both online sales and brick and mortar. So when we're talking general consumer goods, we're referring to brick and mortar, stores you walk into. The blue trend line here is representing online sales, which includes direct payments to agencies with fulfillment centers and indirect e-commerce sales that kind of flow through the countywide use tax pools. Again, we'll talk a little bit more about both of those in a moment. As you can see, online sales have experienced a pretty steady increase over the last couple of years. Pardon me. The green trend line indicates brick and mortar retail sales, which is the group we're focusing on right now. And you can see that has been declining. And when you marry both of those sectors, both online and brick and mortar, we have the gold line, and that's in positive territory. So the data emphasizes that people are still spending, but they're picking and choosing where they're spending, possibly choosing online a little more frequently than walking into stores. So when we say general consumer goods is down, and it is, it contracted 2.3% in the first quarter, and it has been declining over preceding quarters as well. But when we say it's down, it's only part of the retail picture, almost half, a little over half. And it's e-commerce that we're really seeing bolstering the overall retail sector. All right, as we're looking at retail, we look for guidance. This is an example of some of the businesses that are forecasting their retailer guidance for 2025. Many publicly traded companies will report their future guidance kind of as indicative of where they feel their sales are going for the coming year. I will say this year, many retailers lowered their outlooks for 2025 or pulled them all together. So Ulta here, you can see in the beauty industry, is the one green box looking for positive results in 2025. The balance of some of the stores or businesses that we are tracking in California are either flat or decreasing their outlooks, or in the case of Ross, pulling it all together. Lots of economic uncertainty driving those guidance expectations.
We have a question from Ricardo. He's asking, how does California's drop in retail compare with national trends for retail?
You want me to jump in real quick, Tracy, on that?
Sure.
I was just starting to type up a response, so let me see if I can just summarize real quick what I was starting to write. Is that it's hard to compare the data really between the national data. We do track the metrics as part of our forecasting, but hard to compare because in California, you have much of the allocations for the online sales going to fulfillment centers or to the pools. And also you have a lot of services in that data as well, which in California aren't taxed. But we're seeing kind of like the stuff that we're tracking for US retail sales for 1Q overall, we're up about 2%. And that's probably pretty consistent with what we're presenting here today. It's just that it's broken out a little bit differently between the pools, et cetera. Thanks.
Yep. Thank you, Ken. I appreciate that. General consumer goods, like most tax groups, it's sensitive to a lot of variables, but I would say consumer behavior really is primary here. A lot of interesting behavior in the last year, whether it's boycotting businesses, seeking digital shopping instead of walking into a store, having less money to spend, etc. I think our shopping tendencies are really going to be what drives our sales tax in California related to brick and mortar sales. So looking at the outlook, following 2 years of decline in general consumer goods, we anticipate the current fiscal period to be down 2% and really not seeing market increase until the beginning of 2026. So very moderate growth going into the next fiscal period. All right, let's jump into the pools. I kind of referred to them a moment ago when we were talking e-commerce. So the pools comprise a really big portion of local sales tax revenues in California, and they're largely e-commerce driven for the most part. General consumer goods, in this case, now I'm really folding e-commerce into that perspective or into that group. And business and industry are the two largest business types in this group. They both grew in the first quarter results. Autos and transportation represents third-party auto sales, and restaurants and hotels captures online food delivery. If we break it down into the various sectors, the top 10 business types in the pools are about 60% of the total revenues, and they're up 5.3% for the period. The biggest category is marketplace sellers, and these companies are Etsy and Wayfair and Temu and Amazon and many, many others actually that fall into this segment, up about almost 1% compared to a year ago. I will note that the used automotive group is usually in the top 3 for most regions in the state and represents a third-party auto sales. And I think I mentioned that just in the previous slide. It's a tough sector to forecast because it doesn't necessarily always track with new and used car sales, as Ken was talking about earlier. The one other item I just do want to highlight here is electronics and appliance stores. You can see this big 37% surge in the first quarter revenues for that group. This is a result of some statewide audits that moved revenues into the pools out of direct allocation. Overall, the pool is up about 5.1%. All right, things that we consider with regard to the pools looking forward, e-commerce is not going away. Tariffs have not yet had a significant impact in the pool revenues at this point, and we do anticipate consumers to continue spending, particularly in e-commerce and industrial projects to continue to move forward in California, albeit possibly at a slower level than in previous years. All right, looking at the pools, after a really big one quarter 25 at 5.1%, anticipating almost 4% growth in fiscal year 24-25, our current fiscal period. And then in subsequent quarters, looking at 4% growth as well, averaging out to about 3.5% pool growth in 25-26. And if we were to pull this forward into subsequent fiscal periods, really looking at an average of 3% growth. All right, let's look at business and industry as a direct allocation tax group. We talked about business and industrial revenues a little bit in the pool, one of the largest segments in pool revenues. These are direct allocations. I will say that business and industry is a tough tax group. There are 21 different sectors in this group, ranging from energy, utilities, solar to biotechnology, heavy and light industrial, agricultural, I think I mentioned medical biotechnology. So it kind of runs the gamut. I will say, though, that fulfillment centers dominate this group. They are 29% of the total. They grew 6% in the first quarter. They've been growing pretty consistently in preceding quarters as well. And again, this is representing e-commerce, but it is e-commerce orders that are fulfilled in California fulfillment centers. And those are direct allocations to those agencies that have fulfillment centers locally. So this is where we have kind of retail revenue bridging a couple of different tax groups. We have brick and mortar in general consumer goods. We have e-commerce that flows through the pools, and then we have e-commerce that is allocated in the business and industrial group as well. Couple of things to note with these top 10 business types, it's over half of the entire business and industrial group. And energy utilities, which is a large group, is posting a pretty big decline compared to a year ago. This is because of the cessation of a number of large solar energy projects in the state that were happening a year ago. They are now concluded. So that comparable, that comparison really skews the data down. We anticipated this in our statewide forecast, so it kind of came out to pretty much exactly what we were anticipating. It's a volatile category. We see a lot of surges in projects, and then they end and then they come back again. So energy is definitely a big category in the business and industrial sector. Couple of other things to note here, kind of on the flip side, electrical equipment, big surge this quarter. This is some one-time energy related payments this quarter. So when we talk a year from now and we're looking at this comparable data, it'll probably be flipped. And office equipment, similar, but again, flipped. Big payments a year ago in the office technology area that don't repeat in the current quarter. All right. Looking at fulfillment centers briefly, we talk an awful lot about these, and we have in the past couple of years. So these are considered places of sale. These are stores pursuant to current legislation, and we've seen some remarkable growth in fulfillment center revenues since early 2019, both as a result of legislation, shifting purchasing behaviors, and then some statewide audits that identified revenues that were going into the pools should be reallocated into direct reporting, which boosted revenues further kind of during 2020 through 2023. And here we are now in first quarter of 25, still seeing growth in fulfillment centers. As I mentioned, up 6%. They comprise about 5% of the total Bradley-Burns sales tax revenues. All right, industry trends with this very diverse tax group, anticipating fulfillment centers to continue to grow. Other sectors, though, within business and industry, some of the key sectors, heavy and light industry, really facing some headwinds. Key quote, manufacturing sector is downbeat. I think I pulled this from Wells Fargo. Medical biotechnology, while there's some opportunity within this sector, policy and funding uncertainty at the federal level, kind of tempering things down a little bit right now. Medical biotech didn't really show any growth whatsoever in the first quarter compared to a year ago. And then agriculture in the news a lot right now, definitely facing headwinds in California. Tariffs, pricing likely impacting big construction equipment. Retaliatory tariffs on our agriculture exports could impact demand. And then very close to home, immigration and deportation is a major labor challenge in California right now. Looking at the forecast for business and industry, putting it all together, relatively flat for 24-25, just 0.2% growth. So I would call that flat. And then pretty moderate growth going into the upcoming fiscal period as well. Remember that about almost 30% of this revenue is related to fulfillment centers, which is growing pretty dramatically. So it's really propping up this group as a whole, kind of hiding a little bit of the concerns in industry and medical biotechnology and agriculture. Okay, restaurants and hotels. I'm going to shift it entirely and talk about food and travel. These are the key business types in restaurants and hotels. And let's just look at dining to start out with. So casual dining, quick service, fast casual, fine dining are the key segments in the restaurant sector. Casual dining pretty much stands alone this quarter in its gains. The rest of the dining sectors really took a tumble, particularly fine dining. And this is an area that we've seen some decreases in preceding quarters as well, as folks are just pulling back and looking for more value. And then hotels, motels saw a little bit of a bump in first quarter results, as did food delivery and catering. But overall, the punchline is restaurants and hotels as a tax group is down 0.1%. So while that's relatively flat, it's negative, and it's the first time in a number of years we've seen this group take a step down. And one of the primary reasons for this really is related to Southern California, and the fires in Los Angeles County really played a significant role in those first quarter revenues, effectively impacting both hotel and restaurant and leisure and entertainment revenues for almost the entire month of January. Many tourist areas, hotels, restaurants temporarily closed. Some are permanently closed. So Los Angeles County as a whole down 3.9%. If we pull them out of the mix entirely, the balance of the state was actually up 1.4% for the quarter. So again, the wildfires having a very negative catastrophic impact. And we see that in the sales tax data for the quarter as well. All right, quick discussion on AB 1228 came into play on April 1st of 24, requiring the increase to the minimum wage. I know we've discussed this a couple times in past webinars as well. The industry has been really struggling with kind of a persistent labor shortage and cost increase. So when AB 1228 came into play in April, it just kind of heaped more challenge onto a growing mound of challenge. Many businesses had already pivoted to address the labor shortages and cost increases by adding automation. We've all seen the kiosks, the self-pay kiosks in a lot of fast food businesses. Reducing menu options, reducing portions, shrinkflation. The jump in wages really added to that. I will say that with rising menu prices, which is one of the tools that restaurants have to kind of combat some of these cost increases, will increase sales tax revenues if it does not deter diners. This slide is kind of interesting. If we focus on the bottom half at first, these are labor numbers. So with this line here in the middle indicating AB 1228, you can see labor numbers, employment numbers coming down ever since that legislation came into play. But up here at the top of the screen, you can see those businesses subject to this legislation still continue to grow all the way up through fourth quarter of 24, albeit at a lower level than in preceding quarters, and really not seeing negative impact until the first quarter of 25. Of course, some of that driven by the fires in Los Angeles County. All right. Considerations with restaurants and hotels, restaurant performance, quick service, fast casual, definitely decline in first quarter. Casual dining is the one steady sector here, probably because if you're going to spend more money to eat out, you might as well sit down and enjoy yourself. High levels of uncertainty in the first quarter, coupled with the wildfires, really dragged down the overall restaurant performance. Anticipating consumers likely to pull back on some of their leisure and travel spending, although there are some indicators that second quarter might look a little bit better compared to the first quarter results. And then, of course, international visitor spending in California is expected to decrease in 2025. So definitely a few headwinds there that we're considering with the restaurants and hotels forecast, which for the current fiscal period, pretty low growth compared to prior years. 1% growth in this whole group of restaurants and hotels, and then stepping it up a little bit as we go into the upcoming fiscal period. And if I were to take this out a couple of years, we'd probably be at 3 to 4% growth in the out years. But right now, definitely seeing just a slowing in this area that we have not seen in previous quarters. So with that, I will end and turn it over to Ken to wrap it up and bring us home.
And I think
you're
You mute, Ken.
Oh, thank you. It's always, well, anyways. Thank you very much for doing that. If you roll up all of what Ken and Tracy have walked through the 8 groups that we just discussed, you get these annual results. And you can look here and see that, back in the COVID year, let me just grab the pointer there. We had a late spring effect, of course, of the COVID and everybody sheltering in place and stores closed, pulled revenues down. There was quite a explosion of spending, federal stimulus money, inflation that boosted the last couple of years. What's interesting in the data here for me, looking ahead until fiscal year 25-26, revenues are expected to grow about 1.8% when we roll up all those categories. It's roughly $9.4 billion, but it's a little hard to see in the bars here, but that's almost exactly the amount of money that was collected back in fiscal year 22-23. And so we're in a little bit of a valley period here where revenues were down in the prior year. They're going to be down this year, and in real dollars, not really growing until we get out into this fiscal year 26-27, where revenues are starting to inch up the Bradley Burns totals on a statewide level, getting closer to $10 billion on an annual basis. Just some things for all of you to kind of summarize and keep an eye out for. Obviously interest rates are a component of what goes on, and understanding, will the Fed act, and when will they act, to what extent will they act, and at the end of the day, will that have any major influence on how consumers respond to that in terms of their spending patterns. Tariffs that are in place today, to some extent, aren't really even seen when you walk into a store or other places to get things because of all the front loading of importing of goods. But we definitely acknowledge that those are going to be much more visible in the coming 6 to 9 months. Again, we'll have some effect on how shoppers behave when they start absorbing these price increases. Not really sure to what extent or where households can pull back on spending, what might be deemed essential versus discretionary. And so we'll be looking for that. We've touched on today at several points, just a lot of things going on beyond the state and our own country So across the globe, there's just a lot of geopolitical activities that are leading to uncertainty. And so our outlook here is, for you to consider that while we're forecasting on a statewide basis, there are a lot of moving parts. So there's going to be some volatility and unexpected events that are going to influence what the outlook looks like in these coming quarters. Wanted to highlight for you today, we're expanding our scope of services. Something we've just put into place is the ability to offer a post-compliant investigation program, helping agencies with public safety services to hire police officers or sheriffs or other public safety folks and work through the and try to expedite and do that quickly. All the background investigation work, which can often be quite consuming for local government. And so we have a new service that's teamed up by some folks, all with public sector and public safety background, decades of that, frankly. And so we're going to be offering this, and you'll be seeing more of this for those of you that will be involved in our upcoming client meetings here over the next couple of quarters. So I don't have my chat open, but just to keep the screen looking big for me. But if there's other questions that someone would like to ask, we just want to make sure that the three of us have an opportunity to see that and respond accordingly. So I don't know if Ken or Tracy, if you see anything there.
Yeah, there's a couple questions that have popped in. First one was a question from Southern California. Please discuss the impact of immigration enforcement. There's a percentage of the population who are afraid to leave their homes. They're not going to work. For spending, what are your assumptions? And I got to say, that's a real issue. I'm also in Southern California. I went to a Spanish church service this last Sunday. It was half empty. There was a communication from the pulpit that basically communion is going to be taken to people's homes. They're afraid to come in. There's going to be a switch over, just like COVID, to televised. So it is a real issue. Went to a Argentinian restaurant afterwards, pretty empty compared to what it usually is that time of the day. So it is going to be a real issue. And I think we did factor it to some extent into our thinking about our outlook going forward, but it is really hard to quantify, as you can imagine. And so we'll have to wait and see. We definitely took that into consideration, but it's not sure yet exactly what that impact's going to be. So we're going to have to watch that. And then the second question, and if you guys, Tracy or Ken, want to jump in, please. But another question, forecasted cost increases that were baked into 24-25 projections did not materialize to the extent forecasted. Markets are reflecting positively on the lower than anticipated increases. Does HdL interpret the shift? And my understanding of that question, and you guys jump in, but I think it's basically asking about, we'd anticipated a little bit more of a bump in the tariffs maybe in our last webinar. And the markets in April had a big sell-off and have since come back, reflecting a lot of optimism. Any comments from you guys on that? Or
I would just add, I think we're consistently, like people on the call, watching the markets and seeing so many things are happening in real time and day to day. So we did have an earlier, I think, anticipation that there might be more of a tariff effect. But of course, keep in mind, those were under scenarios changing daily. Were they going to be 150% or 10% or 25%, and which countries or what products? And so now I think we have, as best we can in real time, tried to roll what the tariff assumptions look like into this current outlook.
Yeah, that's great. And I would just add on to that our forecast overall in 1Q25 came in very, very close. And I think I would have, for the auto sector, at least anticipated a little bit more of a bump up with dealers not wanting to wheel and deal like they might otherwise would, given that they know tariffs are coming. And so they might have taken that opportunity to raise prices. But as we saw through April, there wasn't a lot of that yet. But it's still early days, right? And so it was just imposed. Our data goes through March, and most of the tariffs didn't really get put into effect till April, May-ish.
Okay. Well, I see that we're at the top of the hour, so you have here our contact information for any of you that might have further questions based on what you've heard or seen today. I want to thank my colleagues, Tracy and Ken, for joining me and contributing to this webinar, and Johnny behind the scenes helping do a lot of the technical work. We look forward to seeing all of you in our next webinar in September. So please have a great summer.